Thank you all for joining us today, and welcome to our Cedar River Capital fourth quarter market touchstones update report. My name is Paul Latta, and I have with me my business partner, Baj Kochar. As most of you know, Baj is co-founder of Cedar River Capital and has over 15 years of investment industry experience in the equity capital markets and fund management areas. Baj, we look forward to hearing your insights today.
Thank you, Paul. Paul also has extensive experience in the investment industry and has been widely quoted in the Wall Street Journal, CNBC, Barron's, and other financial media. Let's start off by looking at a broad overview of the investment environment today.
COVID is still dominating the narrative, both in the media and in the investment industry. Today we'll be talking about COVID and where we stand in particular on the vaccine front. We'll also be talking about the response at the level of government, at the industry level, and at the human level, the level of the people. All of these factors are important in understanding the market action, not just in the stock market, but also bonds, currencies, real estate, commodities, and other markets. How much is COVID dominating the narrative? This chart from The Economist gives an inkling of how huge the COVID story is. Based on their own publications, 20 of their 24 most read articles in 2020 were about COVID. Only 2 were about the US presidential election, the next most popular subject. In other words, the narrative around the US presidential election is only 1/10 the size of the narrative around COVID. And granted, this is only one publication and the data covers all of 2020, not just the fourth quarter. Still, it shows quite visually the transfixing power of a pandemic. This is what matters. Monday, November 9th is a day we'll all remember. It was the day that Pfizer announced its final phase 3 data for its COVID vaccine. The Dow Jones lifted over 1,000 points intraday on the news. Strong efficacy data, good safety data. It was a veritable slam dunk for an FDA authorization, an authorization it indeed received just a few weeks later. As you can see from the chart here, Pfizer and its joint venture partner BioNTech was the first horse across the FDA finish line, but the Moderna vaccine was just a mere 3 weeks behind Pfizer, and there are 3 more due in the coming weeks, beginning with the AstraZeneca drug, followed shortly thereafter by likely Johnson & Johnson and Novavax. It's encouraging to see all these additional vaccines working their way across the FDA finish line and giving additional choices to people, knowing that each vaccine will have strengths and weaknesses for different people in different situations. Just more tools in the toolkit. In our prior quarter Touchstones presentation, we also mentioned that there were a handful of vaccine candidates from China that were in various late-stage testing and could see FDA approval in the short order. The next slide looks at these Chinese treatments, plus a high-profile Russian vaccine with the memorable name of Sputnik 5. If you live outside the US, there's 4 additional COVID vaccines that have been selectively approved by various non-US drug regulators, despite limited clinical data. Probably at the top of the list is the Gamaleya vaccine, which is the Sputnik variant. Interesting that Russia did approve this here just a few weeks ago. However, in the US, that particular drug, that patient count is quite small and is probably too small to win any sort of FDA authorization at this point. It may age into an authorization at some future date, but for now, that one is probably not going to make it into the US in a timely manner. The other 3 early approval vaccines are all Chinese. And we're still awaiting late-stage data and believe this data is imminent, in particular for Sinovac and Sinopharm, probably within the next few weeks. Most analysts, however, are modeling revenues for these vaccines to be mostly from third world countries. But if the data is quite strong, a US FDA authorization is actually possible. And of course, there is merit to having a vaccine in the US toolkit using the old school approach of inactivated virus like Sinovac is using. It's an approach not really used by Pfizer, Moderna, a lot of the others that are using sort of the modern technology with messenger RNA. And some folks are actually a little bit worried about the modern technology being less tested than the old school inactivated virus technology. This chart is from the Institute of Health Metrics, and for those who might surf this site regularly, this chart is notable since the Institute is finally projecting a decline in the COVID death rate. Institute is also projecting a parallel decline in infections. I didn't show that chart. This one just looks at the death rate, but at least we can see the number going down, not persistently going up. The game changer, of course, is the vaccine approvals in the past month. And while it does look like the worst is still just a few weeks in front of us, at least it's encouraging to see that there is light at the end of the tunnel. Of course, an imminent reversal in death rate does not mean things return to normal straight away. Vaccinations will be ongoing for months, and there will be folks who refuse to take vaccinations. And of course, there'll be some level of social stigma still associated with crowds that might take some time to go away. Full recovery for some businesses may take years, not weeks. But at least with vaccinations now, we're moving forward.
The prior slides were about the progress of the COVID situation. We'd now like to talk about the response to the COVID pandemic from government, industry, and society. This particular slide looks at the U.S. government response. We've discussed this at length in our prior Touchstones presentations, so we will only give a thumbnail summary here with an emphasis on what is new. The Fed continues its QE program, and while the rate of growth of the Fed balance sheet has slowed, it is still growing at a meaningful pace, a comparable pace during the financial crisis of 2008 and 2009. The Fed has also been vocal about the need for more fiscal support. The U.S. economy will now be getting a supplement to the original $2.2 trillion CARES Act. The new legislation includes an additional $900 billion in fiscal spending, part of which is $600 checks to consumers and U.S. citizens below a certain income level. Notable, most non-U.S. governments are also seeing similar fiscal and monetary support during the pandemic. The U.S. is not going it alone here. U.S. money supply went up sharply in 2020, which suggests the potential for future inflation. What we're looking at is the M2 money stock. M2 money supply includes cash, checking, savings accounts, and money market accounts. It's a measure of how much money consumers have in essentially their wallets. And that money is available to be either spent, saved, or invested. Now, interestingly, money supply has been steadily increasing since 2006 on this chart, from just over 7 trillion in 2006 to just under 15 trillion at the beginning of 2020, at a pace of about 1.75 trillion per year. During that time, and we'll get into this in another slide, inflation did not appear in a meaningful way, even though the money supply was steadily increasing. During 2020, due primarily to both monetary and fiscal intervention, the money supply jumped by $4 trillion in just a single year. As we mentioned before, the U.S. government was not alone in its sizable fiscal and monetary response to the pandemic. Governments around the world were faced with the same pandemic and have had a similar and coordinated response. What we're looking at here is the money supply increase among the OECD member countries. The OECD stands for the Organization for Economic Development and Cooperation and includes most of the countries in Europe, the US, Australia, and Mexico. Notably, it excludes China and India. That group of countries also increased its money supply sharply in response to the pandemic. The rest of the world did as well, although not quite as sharply as the OECD. With the lift in money supply and increasingly dovish central bank commentary, it should be no surprise that inflation expectations have lifted. That said, the lift in inflation expectations really only reverts to pre-pandemic levels at present in most countries. A modest lift in inflation expectations amid a sizable lift in money supply reflects the depth of the current COVID economic challenge. Collapsing money velocity is holding the lid on inflation for now. The velocity of money is a measurement of how quickly money is exchanged in an economy. When consumers and businesses spend money, it increases the velocity of money. When consumers and businesses save money, it decreases the velocity of money. Interestingly, since 2006, the velocity of money has been declining steadily. The reason for this is probably an increase in the concentration of wealth, as high net worth households probably spend a lower percentage of their income and savings than low net worth households. Money velocity took a giant dip in 2020, primarily due to COVID. Even with the stimulus checks that we saw in the CARES Act, about half of that money was saved consumers stuck at home just cannot spend money at the same velocity as they can when they're out about and consuming. This chart shows the impact of COVID on corporate earnings. Consensus earnings dropped about 25% in the initial weeks of COVID and have since regained about a quarter of what they lost. This chart is helpful from a contextual standpoint since the sizable GDP declines in Q2 and rebound in Q3 seem to add much more noise that obfuscates understanding. Furthermore, the media seems to focus on the most troubled industries, such as those in travel and destination entertainment. There are companies like Amazon that actually performed better in the pandemic and stay-at-home environment. And there are companies where the tailwinds may equal the headwinds. But on balance, corporate earnings took a big dip in 2020, not surprisingly, but are forecasted to recover considerably in 2021 and 2022, which implies meaningful economic growth over the next couple of years. It is interesting to look at the economic impact of COVID on various sectors. Personal consumption expenditures took a big dip in 2020, and then by the end of 2020 recovered almost fully. But interestingly, expenditures on goods, i.e. items people can consume and order at home, took an initial dip in 2020, but recovered to levels that exceeded prior highs. Not surprisingly, consumption expenditures on services declined in 2020 and have not yet fully recovered. Different sectors of the economy also saw very different results. E-commerce, for example, took a big boost in 2020 and will probably see a lasting impact from a change in consumer behavior. Some expenditures were postponed, but will probably see catch-up demand. An example of that would be hospital capital equipment or orthopedics. Airlines, cruise lines, and restaurants will probably see their revenues eventually recover to pre-COVID levels. However, the companies in these industries had to take on a considerable amount of debt to navigate through the pandemic, and their balance sheets will be much weaker in the future than they were pre-COVID. Investing may become more complex going forward as companies that have benefited from COVID may see slower than expected growth going forward as some of the demand was pulled forward. Companies that were hurt by COVID may see a significant recovery in revenues and earnings, but they may have much weaker balance sheets going forward. Sometimes there is a disconnect between the equity markets and the overall economy. And what we're seeing here is consumer confidence took a big dip in 2020. And while the equity markets have fully recovered and actually showed a sizable net gain in 2020, consumer confidence has not yet fully recovered. The equity markets are obviously expecting a rebound in consumer confidence to pre-COVID levels, but it is important to note that this has not yet happened. The employment situation has improved but has not fully recovered. As you may recall, in March, the U.S. economy saw the most significant increase in unemployment, i.e. the most significant drop in employment in its economic history. We've recovered about halfway from that giant drop, but not fully to 2019 levels.
We'd now like to switch topics away from the economy and in the direction of the capital markets with an emphasis on the stock market. These two charts show that both the stock market and bond market, well, they're both near all-time highs. We suspect that the low rate environment will be challenging for both markets going forward, though only the bond market is really bounded by zero since stocks can also grow with growing earnings, not just lower rates. We'll chat more about this in coming slides, but first we'll look a little bit more about the stock market in the most recent quarter, the fourth quarter. The fourth quarter, of course, will be a very memorable quarter, mainly due to the vaccine approvals and, of course, Pfizer's amazing clinical data that came out on November 9th. However, the vaccine approvals and Pfizer's clinical data actually had a profound effect on market leadership. One would expect a vaccine approval would be a nice boost for, say, a COVID-troubled industry, maybe an airline or a hotel. But what instead happened after November 9th was that anything that was underperforming started to outperform, and anything that was outperforming started to underperform. And when you look at the fourth quarter in total and compare it to the year in total, you can have this list here that we have on the slide here, the 2020 leaders, large cap growth, but in the fourth quarter, nope, it was the opposite. It was small cap value. In 2020 as a whole, yeah, it was mostly COVID winners, the Zoom, the Netflix, the Amazon, but not in the fourth quarter. It was those troubled value industries, all the COVID losers. The strong dollar sectors were generally leaders throughout 2020, but not in the fourth quarter. It was opposite world. Same deal with US stocks versus non US stocks, momentum versus high beta. Anyway, it was a very strong U turn, likely driven again by the exchange traded funds and passive money. And I'm pretty sure over time, this oversimplified U turn will become a little bit more refined. Anyway, very interesting turn of events, so to speak. The investment bankers have been quite busy in 2020, thanks both to the strong capital markets and strong COVID induced capital needs. It does appear from a stock market perspective that deal quality is an issue, in particular with the meteoric rise of the SPAC, the backdoor IPOs, of which there's been nearly 200 of those this year. We do worry a little bit about this weighing on future private equity returns by pushing the fast forward button on deal pipelines and releasing investments before their time and strip mining future liquidity events. Regardless, it's been a very strong year for capital raising this year. Suspect next year is probably not going to be quite so strong, mainly because, well, this year was so strong.
We thought it might be useful to look at market valuations based on the CAPE ratio. The CAPE ratio is a way of measuring cyclically adjusted price to earnings. It takes the price of equities divided by the average earnings over a 10-year period. It attempts to smooth out the business cycle and look at valuations relative to the course of an entire business cycle. Currently, equities look somewhat expensive relative to historical CAPE ratio valuations, although not nearly as expensive as they were during the 1999 and 2000 dot-com peaks. However, based on bond yields currently, and looking at the chart on the right, the excess CAPE yield, which is the earnings yield minus the bond yield, does not look expensive relative to where they have been in the last 10 years. This is because bond yields are so low. So equities are actually much cheaper than bonds. We've talked about this in prior Touchstones decks, although both are expensive relative to where they have been historically.
In the prior chart, we compared stocks to bonds, demonstrating that stocks are generally more compelling than bonds, mainly due to the incredibly low bond yields we have these days. In this chart, we compare bond yields to commercial real estate cap rates. No surprise that real estate cap rates have been tracking interest rates lower over the last several decades. As you can see in this chart here, the correlation is there. It's not perfect, but it is broadly there. Yeah, you can see here recently, just in the last year or two, that the real estate cap rate has been elevated relative to the bond rate, and the spread is actually fairly wide recently. That would suggest at a very broad level that real estate is more compelling than bond yields, a similar conclusion to what we arrived with the stock market. And I do think at a broad level that is true. However, I put the little asterisk on here that, again, this chart ends in the middle of 2020, and there's been quite a spread in performance across the major real estate sectors. And in particular, the commercial central business district office building space has become a lot more challenging, with a lot of people working successfully in stay-at-home jobs and quite a few people reluctant to return back to work. And that does sort of taint that sector a little bit. So just because the spread is wide doesn't necessarily mean it's a better investment. At a broad level, perhaps true. At a subsector level, perhaps not so true. This chart here is the commodity markets over the last year. This is the S&P GSCI commodity ETF. And in particular, in the last few months of the year, last 2 months, actually since the November 9th vaccine news from Pfizer, we've seen a nice little commodity rally. We've actually seen an even bigger commodity rally in commodity stocks. the actual underlying commodities have also rallied, but the stocks in particular saw an enormous rally. We chatted about that in an earlier slide. Why are the commodities rallying? Well, clearly, if you announce a possible vaccine, there's a lot of inventory stocking, and yet the production for a lot of these commodities is down. So you've got a lot of wholesalers stocking at the same time when supply is down, and so there's been a rally in the prices. And to be fair, the prices in the first half of the year, we actually saw oil in particular actually saw a negative print there back in April. Now those prices are really too low to be economically viable, and so some of the prices were just simply too low to begin with. Also, we do have a situation with the Fed out there endorsing price increases and inflation, trying to fight off the decline in money velocity with a huge increase in money supply. And so at a broad sort of cultural level, if the Fed is endorsing inflation, perhaps these also endorsing price increases on oil and on copper and on aluminum and corn and wheat and everything else in the commodity basket. At the same time, we've also had some weakness in the U.S. dollar, and a lot of folks are connecting the dots that whenever the dollar weakens, there's a tendency for commodities to strengthen, and that clearly is a factor. We'll talk a little bit more about that. This is a chart of the trade-weighted dollar over the last 5 years, and you can see in the yellow area to the right, in the early days of the COVID pandemic, that the dollar strengthened quite a bit, which was basically a flight to safety. People that had assets in Brazilian real or Vietnamese dong or Turkish lira suddenly decided that they would be safer in US dollars. And so quite a flight to safety, everybody in the currency markets buying US dollars. But since a response with quantitative easing, not just at the US Fed, but central banks around the world, capital markets have recovered quite a bit. And the flight to safety of US dollar has reversed, and people more animal spirits and seeking out investing in Brazilian real or Turkish lira or other foreign currencies. That's the main factor with the weakening of the dollar. At some level, currency markets can be a bit of a momentum play, and so you could say that it may have overshot a little bit since it's actually lower than where it was prior to the pandemic. Fair enough. There are a few other factors that might be weighing on the dollar right now, which may have pushed it below where it should be. First, of course, some folks will cite the fact that the Fed is chatting in a more inflation-friendly manner than it has in the past, and suggesting that inflation might be a factor. That could be weighing on the dollar, although in fairness, other central banks around the world are saying the same thing, and so probably not a big factor. It might be a small factor. Another factor too, and we chatted about this in the prior slide, the commodity prices are starting to strengthen, which could very well be due to the weakening of the US dollar here just in recent months. But sometimes that causality goes both ways, where the weakening dollar can strengthen commodities, and strengthening commodities can weaken the dollar. And so hard to say chicken versus egg in that argument, but the fact that the commodities are strengthening could lead to a weakening dollar. Some other folks have suggested that uncertainty around the presidential transition. I think that's a bit of a stretch. That it certainly a headline maker, but usually doesn't move the currency markets that much. One other factor that gets mentioned quite frequently as a cause for the weakening dollar that I would regard as a very much a non-factor, that would be the high U.S. debt levels and the quantitative easing, the factors that are certainly prevalent in the euro, in the Chinese yuan, in the Japanese yen, the British pound. All those currencies that are strengthening from the dollar weakening have the exact same thing going on. So clearly that's not it. So regardless, we do have some weakening of the US dollar that's going on. It's a little bit more than I would have guessed. Not a lot more, but a little bit more. And if it keeps trending, well, that might be an issue. We'll talk a little bit more about why that might be an issue on the next slide. It's important to keep an eye on the US dollar, since the US dollar can determine market leadership. We borrowed this little picture here from the piece on our website on the myths and misconceptions of the US dollar. And buried in the piece, we have this little observation here that the strong dollar does have a tendency to lift finished goods, the consumer, technology, and biotechnology industries, whereas a weak dollar is usually just the opposite. A weak dollar is actually usually good for the raw material end of the value chain. Weak dollar is also usually good for non-US businesses and and strong dollar is usually good for U.S.-based businesses. So do need to keep an eye on the U.S. dollar. It will be a big factor to determining market leadership. Not the only factor, of course, but a big factor. Thank you again for listening to our Cedar River Capital Mid-Year 2020 Market Touchstones report. Please feel free to reach out and ping us if you have any questions or comments. Please take a look at our website, cedarrivercapital.com. And again, thank you for listening and thank you for tuning in.